Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Right now, there is a 28-year-old out there who has never run a company in their life.
Right.
And they just walked into a bank, borrowed $10 million, and bought a remarkably boring pest control business somewhere in the Midwest.
Yep. Happens all the time.
And mathematically speaking, based on the data we have, they are significantly more likely to become a multimillionaire in the next 5 years than almost any visionary tech founder in Silicon Valley.
It's wild to think about, right?
It really is. So, welcome to the deep dive. Today, we are exploring a pathway that completely upends the traditional narrative of what it actually means to be an entrepreneur.
Because we're so conditioned by the media.
Exactly. We're taught that to be a founder, you have to, invent a revolutionary new app in your garage.
Right. Survive on ramen noodles for a decade.
Yeah. And disrupt some massive global industry. But what if you just want to run a great business today? What if you want to be the CEO right now, but you don't have that crazy billion-dollar tech idea?
The contrast in risk profiles between those two paths is it's staggering.
Totally.
We associate entrepreneurship with the 0 to 1 invention phase. But the pathway you just described, which has been quietly operating in the background of the financial world for over 4 decades now.
Wow, 4 decades.
Yeah, it focuses entirely on 1-to-N execution. It has generated massive wealth and created hundreds of young CEOs simply by leaning into businesses that already have undeniable product market fit.
And that pathway is known in the financial world as entrepreneurship through acquisition, or ETA.
Right, ETA.
And specifically, our mission for this deep dive is to deconstruct the search fund model.
Which is fascinating.
It is, because if a venture-backed tech startup is trying to write a hit song from scratch.
Right, hoping the melody catches on.
Exactly, hoping the lyrics resonate. A search fund is basically like buying the rights to a classic proven hit song and just remastering it for a new generation.
I like that analogy.
Because the audience is already there. The rhythm already works. The cash flow is already positive,
Yeah, you just need to bring fresh energy, maybe modernize the production a bit, and scale it up.
But as we're going to see today, buying that classic hit and actually making it grow is, well, it's an incredibly complex, high-stakes endeavor.
Oh, absolutely. It demands an incredibly unique blend of patience, financial acumen, and just pure operational grit.
Yeah.
Because this is not a diversified mutual fund we're talking about. For the investors, and especially for the entrepreneur, the risk is intensely concentrated in a single small to medium-sized enterprise.
Right. You are betting years of your life and millions of dollars of investor capital on one single swing of the bat.
Exactly. One swing.
So to map out exactly how this works for you, the listener, we have a massive stack of sources today.
A really good stack.
Yeah, we are pulling heavily from the Stanford Graduate School of Business 2026 Search Fund study.
Which, that's the undisputed gold standard data set for this entire industry.
It really is.
Yeah.
We also have these deep analytical frameworks from the Yale School of Management, the comprehensive 2026 Search Fund Primer, and some really interesting legal and structural guides from active ecosystem firms.
Right. They're firms like Athenian, Bishop, and Sewell, and Transmedium.
Exactly. So we are going to look at the exact timeline. We'll look at the intricate financial engineering that makes this possible.
And we're going to compare search funds directly to the titans of traditional private equity, which is a really important distinction.
Oh, for sure. And we will unpack the brutal failure rates, too, because we have to be clear, this is absolutely not a guaranteed path to success.
Not at all.
And finally, we'll reveal this wild psychological paradox of what actually happens to these young CEOs on exit day.
Yeah, the exit day paradox it's something nobody talks about.
No, they don't. But before we get into the heavy legal structures and the math and all that, let's wind the clock back to understand where this idea even came from.
Right.
Because the origin point is 1984.
1984 at the Stanford Graduate School of Business. It was Professor H. Irving Grousbeck. He was the director of the Center for Entrepreneurial Studies at the time, and he really pioneered this whole concept.
So what was his motivation? Why invent this very specific vehicle?
Well, he recognized this recurring frustration among his students. He had these brilliant, highly capable MBA candidates, right?
Right.
And they possessed all the analytical skills necessary to manage a balance sheet, optimize a supply chain, grow a business.
All the operational stuff.
Exactly. But they completely lacked that singular disruptive idea required for a venture-backed startup.
Ah, okay.
They were operators by nature. They were not inventors.
So they were the kinds of people who could take a $5 million company and turn it into a $20 million company.
Yes.
But they just didn't have the technical background to, say, code a new software platform from scratch.
Precisely.
Yeah.
And Grausbeck saw that untapped talent pool, and then he looked at the broader macroeconomic landscape.
Okay, what did he see there?
He realized there was a massive demographic of retiring small business owners.
Oh, what do they call it? The silver tsunami?
Exactly, the silver tsunami. These were people who had built solid, highly profitable companies over decades, but they had absolutely no succession plan.
Right, because their kids had grown up, gone to college, and they had zero interest in taking over the local manufacturing plant.
Or the regional HVAC service company. The kids wanted to work in finance or tech.
Wow. So Grausbeck just connected those two dots.
He did. He created a structured financial vehicle to connect these two groups. The hungry, capable MBA graduate and the retiring owner of a profitable, unglamorous business.
That's brilliant.
It is. He famously called it the most direct route to owning a company that you yourself manage.
And then later on, Harvard professors Richard Ruback and Royce Yudkoff really helped popularize the concept to a wider audience, right?
Yeah, they really turned it into a formalized path.
But, okay, hearing all these origins, I have to say, it raises a massive red flag for me.
Oh, yeah. What's that?
Well, if a 28-year-old with basically zero CEO experience comes to me asking for money to buy a company, my immediate thought is, how does the math actually work without the bank literally laughing them out of the room?
That's the $1 million question.
Yeah.
Or the $10 million question.
Right. You don't just walk in and ask for $10 million. But the sources outline a very specific two-phase engine that makes this entire model function.
The two-phase structure is the secret sauce.
So let's look at the mechanics of phase one, the search capital phase.
Yeah. So in phase one, the aspiring entrepreneur, who we call the searcher, they do not have a company to buy yet.
They have nothing.
Nothing. They don't even know what industry they might end up in or what state they might live in.
Wow.
They're essentially raising money just to fund the process of searching full-time.
And the numbers here are fascinating. I was looking at the Stanford data, and the searcher goes out and raises roughly $400,000 to $600,000.
Right, usually around $500,000.
And they usually raise this from a group of 10 to 20 individual investors.
Yes.
Which means, if you do the math, each investor is writing a check for somewhere between $25,000 and $50,000.
Exactly. And that capital pool has a highly specific budget.
What does it actually pay for?
Well, first and foremost, it pays for the searcher's salary.
Okay. How much?
Usually a modest $80,000 to $120,000 a year.
Modest for an MBA, I guess.
Right. But it allows them to quit their consulting or banking job and dedicate 50 to 60 hours a week entirely to deal sourcing.
Okay, that makes sense. You can't do this as a side hustle.
No, definitely not.
Yeah.
It also pays for their travel to visit target companies across the country. It covers preliminary legal fees, accounting advice, and this is a big one. It pays for crucial access to expensive, proprietary deal sourcing databases.
Like Bowhurst or PitchBook?
Exactly. Bowhurst, Mark-to-Market, PitchBook. Those subscriptions aren't cheap.
Right.
And this search phase is legally structured to last a defined period, typically 18 to 24 months.
Okay, so I was looking at this phase one structure, and I have to admit, it sounds like a terrible deal for the investor on the surface.
It does sound counterintuitive.
I mean, why on earth would an investor pay someone's salary just to look for a company?
It's a leap of faith.
To me, it sounds like buying a VIP pre-sale ticket to a concert before you even know who the band is, or if the concert is even going to happen. You're basically funding a scavenger hunt.
That's a really good way to put it. And the risk in phase one is indeed massive. The sources are absolutely unequivocal about the failure rate here.
Which is high, right?
Roughly 30 to 40% of search funds fail to acquire a company.
30 to 40%. So if the searcher spends 24 months cold calling owners, touring factories, negotiating letters of intent.
Right. And ultimately finds nothing that meets their criteria.
That $500,000 of search capital is just gone.
It's completely gone. The entity is dissolved. The investors take a total loss, and the searcher goes back to find a normal corporate job.
So what is the mechanical incentive? I mean, why would a sophisticated investor write a $50,000 check for a scavenger hunt with a 35% failure rate?
The incentive is this financial mechanism called the step-up.
The step up.
Yes. It is the defining feature of the traditional search fund model, and it prices the risk of that blind search.
Okay, explain that.
To compensate the investors for taking on that massive early-stage risk, their initial Phase 1 money converts at a significant premium when Phase 2 happens.
Okay, let's walk through a concrete example of that step-up math so we can see the sheer magnitude of the strategy.
Sure.
Let's say I am an investor, and I write a $50,000 check to fund Sarah's search phase.
Okay, so Sarah takes your $50,000 along with funds from, say, 14 other investors. She spends 20 months grinding through databases, making calls, and she finally finds a fantastic medical billing software company. And the owner wants to sell it for $10 million.
Okay, so now we enter phase 2, the acquisition capital phase.
Exactly. Sarah needs to raise the actual $10 million to buy the business now. When she structures that new acquisition entity, your initial $50,000 from Phase 1 steps up.
By how much?
Usually by 50%, so a 1.5x multiplier.
Oh, wow.
Yeah, so your original 50 grand converts into the new company's cap table as if you had invested $75,000.
Okay, wait. That completely changes the calculus?
It does.
It's not just paying someone's salary, it's securing equity at a massive 33% discount for the final acquisition, assuming they actually find a good deal.
Right, it's a risk premium. You took the risk, you get the discount.
And furthermore, the sources point out that these Phase 1 investors get a right of first refusal, right, or pro rata rates, to invest in Phase 2.
Yes, that is a huge benefit.
So I get to look at the medical billing company Sarah found, I get to evaluate all the audited financials, and then I decide if I want to write a much bigger check.
Like maybe $250,000.
Exactly. To fund the actual purchase, alongside my stepped-up search capital.
So the step up rewards the early believers.
Yeah.
You are betting on Sarah the operator in Phase 1, and you get rewarded with highly discounted equity in the specific asset she eventually finds in Phase 2.
Okay, so Sarah has her 500 grand. The ink is dry on the Phase 1 special purpose vehicle. She's got her laptop, her databases, her salary.
She's ready to go.
Now, the clock starts. The pressure is on.
Yeah.
What exactly is she looking for? Because the Stanford data makes it very clear she is not looking for the next generative AI startup.
No, absolutely not. The ideal target for a search fund is almost the exact opposite of a venture capital target.
How so?
The texts use phrases like boring, profitable, and essential.
Boring, profitable, and essential.
Right. Search funds actively run away from high-tech volatility. They do not want binary risk where, a new algorithm update from a competitor could render the entire product obsolete overnight.
They want historical stability.
Yes, decades of stability if possible.
So let's define what boring, profitable, and essential actually means using the Stanford 2026 data, because the numbers are super specific.
They're very targeted. We were looking for an enterprise value generally between $5 million and $50 million.
Okay.
They want an EBITDA, which is earnings before interest, taxes, depreciation, and amortization.
Basically the raw cash flow.
Yeah, they want an EBITDA of $1.5 million to $5 million.
And what about margins?
They want strong margins, typically 15% or higher.
Let me throw out some stats from the Stanford 2024-2025 cohort to ground this.
Sure.
The median purchase price was $16 million. They paid roughly a 6.2x EBITDA multiple.
Which is standard for that size.
And the median target had 25% margins and employed about 30 to 40 people.
Right. So let's make that real for you, the listener.
Yeah.
We are basically talking about Bob's Regional HVAC Company.
Bob's Regional HVAC, the quintessential example.
It provides an essential service that people absolutely have to buy, regardless of whether the economy is booming or in a massive recession.
Right, because if your heater breaks in January in Chicago, you do not check the stock market before calling Bob. You just call Bob.
Exactly. These businesses have high recurring revenue, low customer churn, and usually long-standing contracts with local commercial real estate developers.
And the industry structure is crucial here, too. You don't want to buy a business in an industry dominated by 3 massive global conglomerates.
You get trushed.
You want a highly fragmented industry, right?
Yeah.
With thousands of small independent operators.
Yes, because that fragmentation leaves room for Sarah to buy Bob's HVAC, optimize the software, and then slowly acquire 4 other local competitors to consolidate the market.
The roll-up strategy.
Exactly. But perhaps the most vital component of the entire search phase is finding a truly motivated seller.
A motivated seller,
Like Bob.
like Bob. Bob is likely a founder who has run this business for 30 years. He wants to retire. He has no family succession plan. But crucially, he cares deeply about his legacy and his employees.
Right. And the Yale text spends a lot of time on this emotional dynamic. Because for a retiring owner like Bob, selling his life's work is often like passing the baton to a surrogate child.
That makes sense. I mean, he knows every technician's name.
He went to their weddings.
Yeah.
He does not want to sell to some ruthless Wall Street buyout firm that's just going to move the headquarters, strip the company for parts, and fire half his staff just to boost next quarter's margins.
So that emotional friction is actually a massive competitive advantage for the search fund entrepreneur.
It's their biggest advantage. Sarah can sit at Bob's kitchen table, look him right in the eye, and say, Bob, I am not a corporate spreadsheet. I am moving my family to this town. I'm going to sit in your chair. I'm going to keep your brand name on the trucks, and I am going to run your business personally.
Wow.
And that human element frequently wins deals, even when competing private equity firms are offering slightly higher financial bids.
Because Bob values the legacy protection over an extra $500,000. But, okay, despite that distinct emotional advantage, we still have that brutal statistic hanging over our heads.
The failure rate.
Yeah, a 30-40% failure rate. The 24-month clock runs out, the $500,000 dries up, and they have to shut it down.
It happens a lot.
So if Sarah is a brilliant MBA with a war chest of cash and a mandate to buy a great business,
Right.
how does she mess this up?
Well, the sources highlight 3 common fatal mistakes made under the psychological pressure of that ticking clock.
Okay, what's the first one?
The first is poor time management, specifically during the industry evaluation phase.
How so?
Well, the world is full of fascinating businesses, right?
Sure.
So a searcher might decide to spend 3 days deeply researching the macroeconomics of the commercial landscaping industry.
Okay.
Then they spend 3 days modeling out medical device manufacturing. Then 3 days on logistics software.
I see where this is going.
Right. If you spend 3 days researching 10 different industries, you have just wasted an entire month of your 24-month lifespan without making a single phone call to a business owner.
It's analysis paralysis.
Completely. Because these searchers are academics. They're used to writing perfect, comprehensive research papers.
But this isn't an academic exercise.
No, it's a sheer numbers game. It's a sales job. You have to pick a lane and start dialing the phone.
And the sources mention the brutal reality of the deal funnel, right?
Mm-hmm.
To close one single acquisition, a searcher typically needs to contact 1,000 business owners.
1,000.
From those 1,000 cold emails and letters, they might get 100 to sign a non-disclosure agreement.
Right.
From those 100, they might submit 20 indications of interest. From those 20, they might get 3 letters of intent signed.
And it comes due diligence.
Yeah, and if our rigorous due diligence, 2 of those will probably fall apart because of hidden accounting issues, leaving exactly 1 closed deal.
1 out of 1,000. So if you pause the top of your funnel for a month to read industry reports.
Your pipeline starves and you die.
Exactly. And that relentless grind of cold outreach leads directly to the second major mistake, what the sources call the broker trap.
The broker trap.
Yeah. Because cold calling 1,000 people is exhausting. It's constant rejection. So searchers often turn to business brokers or investment banks who represent sellers.
That seems vastly more efficient, though, right? The broker just emails you a list of companies that are actively for sale right now.
I can see the appeal. It skips the hardest part of the funnel. But the trap is the competition.
While Sarah still has to go back to her 15 individual investors and convince them to fund this specific deal.
Right. She is at a massive structural disadvantage. Furthermore, as one investor noted in the primer, brokers often only show search funds the deals that credible private equity investors have already reviewed and passed on.
Oh, wow. So you're looking at the picked over leftovers.
Yes.
Yes.
And you are being forced to make complex diligence decisions way too quickly because of the auction timeline.
So you're fighting the heavyweights for the scraps, paying a premium for a business with hidden flaws.
Exactly. And that psychological pressure cooker leads directly to the third and most dangerous mistake.
Oh, it is.
The settle effect.
Just settle effect.
Yeah. Imagine Sarah is in month 20 of a 24-month search fund. She has spent $450,000 of her investors' money.
The clock is loud now.
It's deafening. She has cold called 1,000 businesses, had 3 deals fall apart in late-stage diligence, and has absolutely nothing to show for it.
The anxiety must be overwhelming.
It is. So when an opportunity finally appears, even if it's in a slightly declining industry, even if the cash flows are volatile, even if one single customer makes up 40% of the revenue.
Oh, the temptation to rationalize those flaws and just settle for a suboptimal acquisition is immense.
Huge. She just wants to prove she can close a deal.
So she panic buys.
She panic buys. She buys a flawed company, takes on a mountain of high-interest SBA debt to close it, and sets herself up for absolute misery in the operating phase.
And the sources emphasize a really crucial mindset shift here. While winding down a search fund without an acquisition is painful and embarrassing, the loss of $500,000 in search capital is basically a rounding error compared to the absolute catastrophe of buying the wrong business.
A total catastrophe.
Right, because losing $10 million of acquisition capital and spending 5 years of your life fighting off bankruptcy, that is a nightmare.
The most successful searchers have the emotional fortitude to walk away from a bad deal in month 23.
Discipline is paramount.
It really is. A bad business will consume the operator.
So you brought up competing against private equity in those brokered auctions. I want to pull on that thread for a minute.
Sure.
Because on paper, search funds and traditional private equity look remarkably similar to an outside observer.
They do.
I mean, they both raise money from wealthy investors.
Yeah.
They both buy private, lower middle market companies. And they both try to scale them up and sell them for a profit 5 to 10 years later.
But the structural differences beneath the hood are massive.
Right. They're fundamentally different asset classes, starting with their core investment philosophy.
The Yale texts summarize it perfectly here. Search funds are people-driven.
People-driven.
Yes. The investors back the entrepreneur first, evaluating their grit, their intelligence, their leadership potential, and they figure out what specific business to buy later.
Okay. And private equity.
Traditional private equity is capital-driven. The PE fund raises a massive pool of money. They go out and find a target business, first based purely on quantitative metrics, and then they recruit an experienced veteran executive to step in and run it.
So in private equity, the CEO is basically hired help. They are replaceable.
Very replaceable.
But in a search fund, the young CEO is the focal point of the entire investment thesis.
Exactly. And this philosophical difference dictates the entire structure of the deal, starting with scale and accessibility for the investor.
Let's break that down, because if you are listening to this and you want to invest in a traditional private equity fund, you usually need to be an institutional investor, right? Like a university endowment or a massive family office.
Right. The minimum check size is often $1 million to $5 million just to get past the velvet rope.
But search funds are radically more democratized for individual accredited investors.
Because the enterprise values are smaller, usually in that $10 million to $20 million range. So the minimum check sizes are much lower.
In a search fund, an individual investor might write a check for $50,000 to $250,000 per deal.
Which allows a high net worth individual to build a diversified portfolio across maybe 20 or 30 different search fund deals.
Spreading their risk across various industries, geographies, and operators.
Right. You simply cannot achieve that level of direct, granular diversification in traditional PE without committing tens of millions of dollars.
And then there's the fee structure. This is huge. Traditional PE is famous for the 2 and 20 standard.
The classic 2 and 20.
Meaning the PE firm charges a 2% management fee every single year on the committed capital, plus a 20% cut of the profits, known as the carried interest.
We really need to dissect that 2% management fee because it is a silent killer of returns.
Let's do it.
In traditional PE, that 2% fee is charged on the total committed capital, whether it has been invested in a target company or not.
Wow, okay.
So if an institution commits $10 million to a PE fund, and the fund managers take 3 years to actually find and close on companies, the investor's still paying them $200,000 a year just to sit on the money.
That's crazy. Over a standard 10-year fund life, the management fees alone can eat up 15 to 20% of the total committed capital before a single dollar of profit is generated.
Right. It creates a massive mathematical drag on net returns, which is known as the J curve.
Which brings us to the lean, almost hyper-efficient economics of the search fund.
Search funds are incredibly capital efficient by comparison because the investors are committing capital on a deal-by-deal basis. Remember the right of first refusal in phase 2.
Right.
There is no massive pool of uninvested capital sitting in a bank account gathering fees.
So what is the management fee in a search fund?
It's typically negligible, often 0 to 1%, merely to cover basic administrative overhead.
So how does the searcher make money?
The searcher is primarily compensated through the equity they earn in the business, their carried interest.
This tightly aligns their incentives with the investors from day one. If the business doesn't grow, the searcher doesn't get wealthy.
Exactly. And the governance relationship between the investor and the asset is completely different too.
The sources point out that PE investors are completely passive. You hand over your $5 million, you get a glossy quarterly report with some EBITDA charts, and you have zero say in what companies they buy or how they run them.
Right. But conversely, search fund limited partners, the LPs, are highly active. Because they are investing deal by deal, they evaluate every single acquisition target.
And once the company is acquired, these investors frequently take board seats.
They don't just supply capital, they supply mentorship. They receive highly granular monthly financial reports.
They are actively involved in guiding this young, first-time CEO through their first major crisis, their first major hire, their first strategic pivot.
And the timeline is different too. PE usually holds a company for 3 to 7 years, aggressively optimizing the balance sheet, stripping costs, and prepping it for a quick sale.
Whereas search funds are historically more patient, they hold for 5 to 10 years, focusing on organic long-term value creation.
And because search funds often use SBA loans with favorable terms and target highly cash flow positive businesses, they frequently distribute intermediate dividends back to the investors during that hold period.
Oh, that's nice. PE usually reinvests all cash flow into further acquisitions, and you don't see a dime of liquidity until the final exit event.
All of these structural differences culminate in vastly different historical return profiles.
Let's talk about those returns because I want to push back on the data here a little bit.
Okay.
The 2024 Stanford study cites a historical average of 35.1% internal rate of return, or IRR, for search funds.
That's the number.
Wait, hold on. 35% is absurd. I look at public stock markets returning maybe 8 to 10% on average. I look at top-tier traditional PE returning maybe 15 to 20%. A 35% average IRR stretching over 40 years sounds entirely too good to be true. Is that number skewed?
Your skepticism is entirely justified. You are touching on the fundamental statistical reality of the asset class, the power law distribution.
Okay, the power law. Explain that.
The 35.1% IRR is mathematically accurate, but it is heavily skewed by outliers. Search funds operate on a return distribution very similar to early-stage venture capital.
Interesting.
The ceiling for returns is dramatically higher than traditional PE, but the dispersion, the variance, is much wider.
So it's not that every search fund is returning 35%.
Exactly the opposite. The aggregate numbers are phenomenal, like a 4.5x multiple on invested capital, but those averages are pulled up by a small number of massive absolute home run deals that return 10x, 20x, or even 50x the initial investment.
Think of the search fund that bought a niche software company in 2012 and rode a massive wave of industry digitization.
Right. Those spectacular successes mathematically offset the 30% of funds that fail to acquire anything and the 10 to 15% of acquired businesses that ultimately go bankrupt or return only 1x capital.
It's the difference between aiming for a solid, reliable double every time you step to the plate in private equity versus swinging for the absolute fences in a search fund, knowing you have a higher probability of striking out.
Perfectly said. If you invest in a search fund, you are accepting a higher risk of total loss in exchange for the chance to hit a grand slam that pays for your entire portfolio.
For many LPs, they blend the two. PE for consistency and a basket of search funds to capture that high upside alpha.
Precisely. And while the traditional Stanford model we've been discussing, the 28-year-old MBA raising $500K is the most thoroughly documented. The ecosystem has evolved significantly over the last decade.
The market has adapted to fit different operator profiles and different macroeconomic environments. Let's explore those variations because not everyone fits that traditional mold.
Right. The first major deviation the sources highlight is the self-funded model.
In this scenario, the entrepreneur bypasses the phase 1 search capital raise entirely.
Right. They do not take money from 15 investors to pay their salary. They use their own personal savings, or perhaps money from friends and family, to fund the search phase out of pocket.
The self-funded model trades financial security for equity control.
Yes. In the traditional model, because the investors fund the high-risk search phase, the searcher's equity typically maxes out at 25 to 30% of the acquired company.
But in a self-funded model, because the entrepreneur took all the early financial risk upon themselves, they can keep 40 to 60% of the equity.
In some cases, if they can finance the deal heavily with debt and minimal outside equity, they keep 100% of the business.
The upside is undeniably huge, but the downside is terrifying.
It really is.
The legal sources note that self-funded searchers bear all the broken deal costs.
Yeah, that's a huge hidden risk.
If they spend 3 months doing due diligence on a manufacturing plant, racking up $40,000 in quality of earnings accounting fees and legal bills,
And then the deal falls apart at the last minute because the seller lied about a contract.
the searcher eats that $40,000 personally. And crucially, self-funded searchers almost always rely on SBA 7A loans to finance the acquisition.
Right, and the SBA 7A loan is a remarkable financial tool. It allows up to $5 million in government-backed debt to acquire a business. However, it comes with a massive caveat.
Which is,
It requires a personal guarantee from the borrower.
meaning if Sarah uses an SBA loan to buy Bob's HVAC, and a year later a new competitor enters the market, revenue drops, and she can't make the debt payments, the bank doesn't just take the HVAC company.
No, they take Sarah's personal savings, they put a lien on her house. She is personally bankrupt.
It is the ultimate high-wire act without a net. It requires extreme, borderline, irrational conviction in your own operating abilities.
It does. Now let's contrast that intense single asset risk with a totally different approach. The holding company, or holdco model.
The holdco model.
Yeah, the Yale text calls this out as a rapidly growing segment of the market. This isn't about buying one company, running it for 10 years, and selling it. This is structurally inspired by Warren Buffett and Berkshire Hathaway.
Oh, interesting. So the holdco model fundamentally shifts the entrepreneur's job description. They transition from being a day-to-day, in-the-weeds operator to being a high-level capital allocator.
Exactly. A prime example cited in the sources is Chenmark Capital.
Right.
Instead of raising $5 million to buy one single business, a holdco entrepreneur might raise $10 million to $50 million with the explicit mandate to buy multiple diverse businesses over a multi-decade time frame.
And the mechanics of a holdco are brilliant from a tax and compounding perspective.
Let's use an example. Let's say the holdco buys a highly profitable, mature bakery. That bakery generates $2 million a year in free cash flow, but it has nowhere to reinvest that money to grow. I mean, there are only so many muffins a town can eat.
Right. In a traditional structure, you'd pay that out as a dividend and get hit with massive taxes.
But in a holdco, the central entrepreneur takes that $2 million from the bakery and uses it to acquire a fast-growing landscaping company in the next town over, shifting capital between subsidiaries extremely efficiently.
They build a centralized corporate team HR, accounting, legal, that services all the subsidiaries. They hire experienced general managers to run the day-to-day operations of the bakery and the landscaping firm, while the CEO focuses entirely on sourcing the next deal and deciding where to deploy the cash.
It's building an empire designed to compound capital indefinitely rather than targeting a rigid 5 to 7 year exit window.
Then we see structural variations on the capital side, like the single sponsor model.
Right. Instead of managing a complex cap table of 15 to 20 different investors, the searcher gets backed entirely by one single entity, usually a massive family office or a specialized private equity firm. Hallstatt Legacy Partners is frequently cited as a pioneer here.
That vastly simplifies governance. You only have one boss to report to, one board member to manage.
But the trade-off is concentration risk. You are entirely dependent on that single relationship. If the family office changes its investment mandate halfway through your search, you are totally stranded.
There's also the concentrated model, which simply narrows the search parameters. Instead of looking nationwide for any good business, a searcher might declare they are only looking for B2B logistics companies in the Pacific Northwest.
It severely shrinks the top of the funnel, but it allows the searcher to develop deep, unparalleled local and industry expertise.
And we must mention a trend that the Yale framework notes is gaining serious momentum: impact vehicles.
Yes, impact vehicles. This is an evolution where finance intersects with social engineering. These are models that blend the strict demand for PE-like financial returns with specific, measurable, non-financial goals.
Now, to be clear to you, the listener, we are reporting this impartially as a market trend, thoroughly documented in the source material. It's a fascinating evolution of the asset class.
The core premise remains exactly the same. Buy a highly profitable, stable business. But the definition of value creation is expanded.
The sources highlight firms like New Majority Capital and Oberon Cooperative. Their objective might involve focusing on diversity, equity, and inclusion during the ownership transition.
Or it might involve prioritizing economic mobility for the blue-collar workforce, or even legally converting the acquired business into an employee-owned cooperative over time, while still targeting a competitive IRR for the investors.
Finally, we see the model being exported globally through the emerging markets model.
This is taking the search fund concept outside of the mature markets of North America and Western Europe into developing economies across Latin America, Africa, and parts of Asia.
This is the ultimate high-risk, high-reward play. The sources outline the risks vividly. Severe currency devaluation, unstable legal frameworks, shifting political regimes, and lacking infrastructure.
Yeah, you could execute flawlessly, buy a great manufacturing company in an emerging market, double its revenue, but if the national currency collapses against the dollar, your dollar-denominated returns for your investors are instantly wiped out.
The counterbalance to that intense macro risk is the valuation multiple arbitrage.
Right. In the United States, a solid, growing SME might sell for 6 or 7 times EBITDA in a competitive auction. In an emerging market, because capital is scarce and traditional PE is less active in the lower middle market, a searcher might acquire a dominant, rapidly growing, highly profitable company for 3 to 4 times EBITDA.
The potential for massive organic growth and margin expansion is tremendous, provided you can navigate the geopolitical instability.
It's a financial Wild West.
All right, we've covered the origins, the targets, the competitors, and the various flavors of the model. Now we arrive at the heavy machinery of the deep dive.
The fun stuff.
Here's where we get into the weeds of the legal structures, the taxes, and the vesting schedules. Because if I'm listening to this and I hear, give a 28-year-old $500,000 to look for a business, my inner skeptic is screaming.
As it should be.
How is this legally structured so investors don't lose their shirts to a scam? How do you verify the authenticity of a search fund?
It is a vital question. These are absolutely not unregulated Kickstarter campaigns or casual handshake deals.
Right.
Search funds are highly structured, highly regulated private placements. They operate strictly under the rules of the Securities and Exchange Commission, specifically Regulation D, usually utilizing Rule 506B or 506C.
Meaning Sarah can't just post a TikTok video asking her followers for $50,000 checks.
Correct. To invest in a search fund, an individual must be legally verified as an accredited investor.
What does that mean exactly?
Under current SEC guidelines, that generally requires having an annual income of over $200,000 for the past 2 years, or a net worth of over $1 million, excluding the value of a primary residence.
Okay.
Alternatively, holding certain active professional financial licenses like a Series 7, 65, or 82 qualifies you. This regulatory framework exists to ensure that the people taking these illiquid, high-risk bets have the financial sophistication to understand the terms and the capital reserves to absorb a potential total loss without ruin.
And the legal entity structure itself is highly optimized by specialized law firms like Athenian and Bishop and Sewell. They usually set these up as LLCs or C corporations.
And there's a massive hidden tax incentive lurking in the C Corp structure, right?
The QSBS exemption. This is the kind of nuance that fundamentally alters the math.
Yes. Qualified Small Business Stock, or Section 1202 of the IRS tax code. This is one of the most powerful tax incentives in the American financial system.
Let's explain how that works.
If the search fund is structured correctly as a C corporation from day one, and the acquired business meets certain criteria, such as having less than $50 million in gross assets at the time of acquisition, and the stock is held for at least 5 years, the financial outcome is transformed.
Let's do the math on a QSBS exit to show exactly why this matters. Let's say Sarah buys a company, grows it for 6 years, and sells it, generating a $10 million capital gain for herself and her early investors. Normally, you're paying roughly 20% in federal long-term capital gains tax, plus state taxes. You're losing over $2 million straight to the IRS.
But under Section 1202, the investors and the entrepreneur may be able to exclude up to $10 million, or 10 times their investment basis, from federal capital gains taxes entirely upon the sale of the business.
Wait, entirely?
Entirely. In your scenario, that entire $10 million gain could be federally tax-free.
That is incredible.
It dramatically increases the net cash-on-cash return for the LPs and the operator, making the illiquidity and the risk of the 5 to 10-year hold period highly worthwhile.
Okay, let's shift to the operator's payday, the searchers carry. We mentioned earlier that they earn 20 to 30% of the common equity in the company. But they don't just get handed 30% of a $10 million company on day one and walk away.
No, definitely not. It is locked up in a very strict, complex puzzle designed to ensure performance.
Let's break that down.
The equity structure is designed to align long-term commitment and exceptional financial performance. The operators carry vests in 3 distinct tranches, each representing roughly 1/3 of their total potential equity pool.
Let's walk through the mechanics of each. Tranche 1 seems the most straightforward.
Tranche 1 is the acquisition tranche. The searcher earns the first 1/3 of their equity simply by successfully closing the deal.
This is their reward for surviving the grueling 24-month search phase, sourcing the deal, arranging the debt, and convincing the investors to fund phase 2.
Exactly. So they own roughly 8 to 10% of the company just for getting the keys to the building.
Okay. Tranche 2 is the operational lock-in.
Tranche 2 is time vested. This second third of the equity vests gradually over an operational period, almost always 4 or 5 years.
This functions as golden handcuffs.
It does. It ensures the young CEO doesn't orchestrate the buyout, collect their acquisition tranche, and then quit 6 months later when operating a blue-collar business gets exhausting.
They have to stay in the seat, run the business day to day, and earn their equity month by month over a half-decade.
And then there's tranche 3, the performance tranche. This is where the investors hold the operator's feet to the fire.
The final third of the equity only vests if the CEO hits massive financial benchmarks for the investors.
Right. The industry standard, as heavily detailed in the legal texts, typically requires hitting a 30% to 35% internal rate of return hurdle before that final equity fully unlocks.
Sometimes it's structured on a sliding scale. A small portion unlocks at an 8% return, more at a 20% return, and the final piece at 35%.
But the structural message is clear. You only get your full, life-changing payday if you make the investors incredibly wealthy first.
But the investors have their own safety net woven into the legal docs, right?
Yeah.
The waterfall and the preferred return.
This is the fine print that can absolutely crush a searcher if they buy a slow-growing business.
Let's use an analogy to explain the preferred return because it is brutal.
The preferred return is a structural mechanism to protect the investor's downside capital. It dictates that before the searcher's common equity, their carry is worth a single dollar in a sale, the investors must first receive their original investment back, plus an accumulating compounding annual interest rate, usually between 6 and 10%.
Think of the preferred return like a treadmill that automatically increases its speed by 10% every single year.
I love that analogy.
If your business is only growing its cash flow at 5% a year, you are working 60-hour weeks, but the treadmill is physically pulling you backward. Your equity is being eaten alive by the belt.
Let's do the compounding math on that.
Yeah.
Let's say investors put in $5 million of equity to buy the business, and there is an 8% compounding preferred return, and Sarah runs the business for 5 years.
Okay, do the math.
If the preferred return is 8% compounding annually over 5 years, the investors are owed roughly 1.47 times their initial money before the operator's carry participates at all.
Wow.
So on a $5 million initial investment, the first $7.35 million of value generated at the exit goes entirely 100% to the investors.
So if Sarah works for 5 years but only manages to sell the business for $7 million, the investors take all $7 million. Sarah's equity, all those tranches she vested, are mathematically worthless.
She gets nothing but her base salary for half a decade of immense stress.
That treadmill dynamic forces the searcher to swing for aggressive growth, because if the business just stays flat, the compounding preferred return literally swallows their upside year after year.
Which brings us back to the macro environment of the performance metrics. We throw around this 35.1% historical IRR number from the 2024 Stanford study. But the expert reality check from the data tells a slightly different story for the most recent cohorts of searchers.
Yeah, we must look at the macroeconomic context. The 35.1% IRR is a historical average stretching back to the high interest rate environment of 1984 through the zero interest rate phenomenon of the 2010s.
But the sources note that the 2022 and 2023 cohorts are struggling significantly compared to their predecessors. We are seeing median returns for these recent funds tracking closer to a 1.5x multiple on invested capital and a 20% IRR.
It's still respectable, but a massive drop from the historical average. What changed in the macro environment to squeeze these operators?
Two massive converging factors: debt costs and valuation multiples. Search funds rely heavily on variable rate debt, like SBA loans or seller financing, to leverage these acquisitions. When central banks spiked interest rates to combat inflation, the cost of servicing that debt skyrocketed, immediately eating into the free cash flow of the businesses.
Right. And simultaneously, we saw multiple compression across the lower middle market. Explain multiple compression because that is the silent killer of equity value.
Imagine Sarah bought a business in the peak exuberance of 2021. It generated $2 million in EBITDA, and she paid a 7x multiple, so a $14 million purchase price. Over 3 years, she does a great job. She grows the EBITDA into $3 million. But today, because capital is more expensive, the market is only willing to pay a 5x multiple for that exact same business. So she sells it for 5 times her new $3 million EBITDA, which is $15 million. She grew the profits by 50%, but because the valuation multiple compressed from 7 to 5, the total enterprise value barely moved.
And the debt still has to be paid off. The preferred return has compounded, and the equity value creation is virtually wiped out.
It has been a very sobering reality check for the ecosystem. The power law remains. There were still operators hitting home runs, but the median performance is under intense pressure.
Okay, this brings us to the final phase of the life cycle. Let's imagine the ideal triumphant scenario. Sarah navigated the 24-month clock. She avoided the broker trap. She bought a fantastic medical software company. She grew the EBITDA. She outran the compounding preferred return treadmill. And after 7 years, she is ready to sell.
The dream scenario.
The investors are going to get a massive 4x return. Sarah has fully vested all 3 tranches of her equity and is about to make life-changing millions. It's time for the exit. Who is actually writing the check to buy this company?
There are a few primary avenues for liquidity in the lower middle market. The first is the strategic buyer.
This is a larger corporate entity operating in the same or an adjacent industry, right?
Exactly. For example, if Sarah scaled a regional medical billing company, a massive national healthcare conglomerate might buy them to instantly acquire their software architecture and their customer list.
And strategic buyers are highly desirable because they will often pay a premium valuation multiple.
They can afford to do this because they will realize immediate cost synergies. They can fire Sarah's redundant accounting, HR, and legal staff and fold the operations into their corporate headquarters.
The classic corporate roll-up. Who is the second major buyer?
Lower middle market private equity. If a searcher acquires a business generating $2 million in EBITDA and over 7 years professionalizes the management team, upgrades the ERP software, expands the margins, and grows to $8 million or $10 million in EBITDA, that business changes categories.
It is suddenly prime bait for traditional institutional private equity funds.
The searcher essentially did the hard, messy work of de-risking a small mom-and-pop shop and scaled it up to a size where a $500 million PE fund is interested in deploying capital.
And there are alternatives if she doesn't want to sell outright, right? Like a dividend recapitalization.
Yeah, that's where she goes to a bank, takes out a massive new loan against the newly increased value of the business, uses that loan to pay her original investors a massive dividend that clears their preferred return, and then she keeps running the company while owning a larger share of the equity.
But let's assume it's a traditional sale to a private equity firm. Here's where it gets really interesting. The Yale text points out a massive, almost existential paradox about this exit.
The exit day paradox.
It is presented in business school as this triumphant finish line for the entrepreneur, the ultimate victory condition. But it's not actually an exit for the person who built it.
This is a profound psychological dynamic that catches many first-time operators completely off guard.
Let's dig into that.
The Stanford data indicates that the average hold period for an investor in a search fund is roughly 4.8 to 5.9 years. After that period, the business is sold, the investors get their liquidity event, they celebrate their IR, and they leave.
But the CEO, the searcher who generated that return, rarely gets to leave. Wait, why not? They just sold the company, they've vested their tranches. Why can't Sarah take her millions, step down as CEO, and go sit on a beach in Mexico?
Because the new buyer, especially if it is an institutional private equity firm, is not buying the company to run it themselves. They are financial engineers. They are buying the predictable cash flow. And more importantly, they are buying the specific management team that prove they know how to generate that cash flow. To get the deal done at the premium valuation Sarah wants, the private equity firm will almost universally require her to roll a significant portion of her equity proceeds, often 20% to 40%, directly into the new capital structure.
And they will require her to sign an ironclad employment contract to stay on as the CEO of the company for another 3 to 5 years.
Exactly.
So she gets a massive cash payout, her bank account looks fantastic, but a huge chunk of her net worth is still locked up in the exact same company, and she still has to wake up and go into the exact same office every Monday morning to deal with the exact same supply chain issues.
That's the reality. And this is where the profound culture shock hits the operator. The Yale text uses a brilliant visceral metaphor to describe this transition in governance.
The basketball coach metaphor.
Yes. For the first 5 to 7 years, Sarah reported to her original search fund, LPs. These initial investors are described as acting like a high school basketball coach.
They care deeply about personal relationships, they ask about your family, they mentor you through your early mistakes because they fundamentally backed you as a person during phase 1. They want to see you develop into a leader.
But then you sell the company to traditional private equity.
And instantly, your new board of directors operates like a Division I college basketball coach.
The relationship is suddenly entirely transactional. The grace period for learning is permanently over.
The mandate is brutally clear, as the quote from the text illustrates. Do your job and put points on the board. If you can't, I have someone else who will.
The young CEO transitions from an environment of autonomous, supported entrepreneurship into a rigid, metric-driven, heavily scrutinized corporate reporting structure. They have less independence, less autonomy, and massive pressure to prove themselves all over again to a new set of masters who do not care about their personal development.
It's the ultimate bait and switch. You spend 2 years begging investors to believe in you, grinding through 1,000 cold calls. You spend 5 years bleeding for a company, fighting off the preferred return compounding treadmill, dealing with broken supply chains, clawing your way to a 35% return hurdle. You finally secure the multi-million-dollar private equity exit, only to realize you haven't actually exited at all. You've just sold yourself a brand new job with a much stricter boss.
The financial rewards of entrepreneurship through acquisition are undeniable. It remains one of the most mathematically reliable mechanisms for generational wealth creation for young operators. But the psychological cost, the relentless pressure of the debt, and the reality of the exit require a very specific, durable type of resilience.
It begs the question, when you embark on this journey, are you truly buying your independence, or are you just negotiating the terms of a very lucrative corporate cage? It is something to think deeply about the next time you dream of being the CEO without having to invent the next big thing. Thank you for joining us on this deep dive into the hidden, complex machinery of search funds. We hope this gave you a whole new perspective on what it means to acquire a classic hit. Keep exploring, keep questioning the narrative, and we'll see you on the next deep dive.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.